Today we're going to be looking at a very simple topic, but it's a very misunderstood one, and that is analyzing risk and reward when it comes to making investments. Really important to do and really important to understand, so be sure to watch this video. So I'm sure you've heard this expression, you got to look at the risk and reward. They call it sometimes a ROI, which return on investment. There's all kinds of sayings that come along with this. When you're looking at doing an investment, you really have to look at the risk and the reward. And you have to make sure that they make sense. Today we're going to be talking about things we should really think about when we're looking at an investment when it comes to risk and reward. So let's get started here. As a quick definition, risk is you're putting up a principal capital amount to actually invest into that investment. Let's say you're buying a house, or you're buying a stock, or you're buying crypto, or you're buying whatever. And you're literally buying something and you're spending your hard-earned money on that. So there's risk associated with that. That risk is, are you going to get your capital investment back? I've been in dealings where it looked really good and I was getting good rewards, but never got my return on my investment back, like my initial capital back. So it was a losing position. So that's what risk is. Reward, of course, is pretty simple. It's the profit or the interest collected above, and this is above the capital that you've risked, that you're earning because of the capital you risked in the long run. Now, I'll tell you a little thing here, that if you incur any losses when you are getting back your capital, you have to take it away from any rewards you got to get a real idea of where you're standing. There's a lot of times, I know in the stock world, you can invest into a stock or an ETF, and an exchange traded fund, and you can say, oh, well, I'm getting 15%, or I'm getting 20% dividends off of this. I'm just soaring to the moon. But then later, let's say that ETF or that stock cost you $20 a share, and you can only get back $10. So really, you've lost 50% of the capital that you put into it. You got to put that against any rewards you might have gotten. You might have got 20% over the course of the year on the value that you put in, but you've turned around and lost 50% of the capital. So it doesn't work out. So if you put $100 in and you get $20 worth of, let's say, dividends by the end of the year, if it was 20%, but you lost $50 on it, you're actually a net negative of $30. So you've lost money. So it's important to look at the particular risk and the reward in that sense. There's a lot of factors that will help you mitigate your risk and reward values. The big thing is you always want to reduce your risk and maximize your reward. There's always a fine balancing act, and I talk about this on a lot of videos. If it's too good to be true, probably is not true. So always keep that in the back of your mind. Let your gut at times tell you when it comes to reward whether it's something you should invest into. Okay, let's take a look here. I do have some factors here that are really important, and these to me are the bona fide, no holds barred things you got to do before you invest into something. First of all is you got to get educated on that investment. You need to know that investment as well as you can before you get involved with it. There's multiple examples that I can cite of things that I got involved with that I didn't fully understand. It all came down to not understanding all the fundamentals of that particular investment. Now, I'm going to tell you, every single investment on the planet has some sort of risk. There's no reward if there's no risk. You can put your money into a savings account. What's your risk? Your risk is A, the bank could fold, which is lean, but it's there. There is a risk there. People have lost money in bank accounts. The second one is that inflation can eat away your savings in the long run. You might not lose your money all out, you had it in the bank, but over time, if that money sat there for 20 or 30 years and you're gaining a 1%, but inflation is marching along at 2%, you're technically losing 1% a year. And over 20 years, your buying power is reduced by at least 20% or 30% based upon how many years it is. So there is risk even with a bank account Okay, so you need to get as much education as possible. Sometimes that education is all about understanding, let's say if I'm looking at options trading. I need to understand how options work inside and out, and even ETFs that have options in them. I need to understand not necessarily how they do the options trading, because some of those things are going to be proprietary secrets, but the fact of the matter is I need to understand where do they stop paying if the value gets too low on an ETF. I'm sitting on about $2,000 or $3,000 worth of ETFs that aren't paying out anything, but they promise to pay out 20% or 30%, but they're not paying out because the value is too low on them at this point in time because the markets are down. I didn't get educated enough, and now I'm kind of sitting in a losing position. So I need to decide what I'm going to do, because my value that I put into them are definitely down by 50%. My bad. So always get as much education as you can. The second thing is, what is the time scope of the investment that you're getting involved in? This is really, really important. If it is a quick deal and you can get back your money and double your money in 2 weeks, either A, it's a scam, or B, it's illegal. It's one or the other. Because there's very few things that you can get involved in that has such a short return window. And you have to always remember that. That's critically important to understand. So I found generally the longer the time frame or scope of an investment, usually the better or the more lucrative it could be. Now that doesn't hold true all the time, but I find it holds true a lot of the time, because you have to also even out the fluctuations in whatever market you're trying to get involved in. Sometimes in the housing market, if you're trying to buy a house and sell it, even if you didn't pay real estate fees or anything like that, or legal fees, let's say you took that all off the table, but that's a cost. And let's say you bought a duplex and you started renting out both sides, and your idea was, I'm going to be in this for 6 months and I'm going to sell it, or I'm going to be in it for a year and I'm going to sell it. It's probably not a good thing if all of a sudden over the course of that year the housing property values drop. That does happen. All investments will go up and come down. That's kind of the nature of an investment. What you want to do is you want to ride that averaging over time. Now right now the stock markets, it's late 2023 when I'm recording this video, and the stock markets are significantly down. But I played this game before. In 2016, 2017, I had a significant position in the stock markets then too. My value, my portfolio cut in half. It was worth 50%. Now, I had a lot of people panicking, oh, the sky is falling, the house is on fire, whatever you want to call it, and they sold their stocks. They realized the loss. I knew that the stock market was a little fickle. I knew my positions were good. I did my research. The companies I invested in were solid. That's a thing too. You gotta make sure, that's part of your research. You gotta make sure whatever you invest into is solid. What happened was, over the course of, I think it was about a year that the markets were significantly down, I was watching the markets and I could start to see that change in the market, like that sentiment in the market. What I did was, I just sat on it. By the time I pulled the money out and reinvested it, I was in a winning position. I had actually made money off of it. The markets took off so much that if you look at historically at markets in general, the average rise is about 10% across all markets. If you average them all out, of course. So time scope is important. Okay, it's also important to look at historical performance of an investment before you get involved with it. A good example is dividend aristocrats. If you're getting involved in a stock and it's a new stock, it's a new dividend, and it's been around for 2 months, be cautious. So it's also very important to look at the historical past on a particular investment you're looking to invest into. Because what happens is, if you don't have any history, you don't know how well it performs. It's the same when a bank looks at you for a prospective loan. Let's say you want to go buy a house. They're going to look at your history, and your history is called your credit record. I'm sure you've all heard of that. Now it's important for you to look at the credit record, so to speak, of any investment you're going to get involved in. It's important to say, is this a dividend king? A dividend king, I believe they've paid out a growing dividend for at least 50 years. That's significant. Maybe the stock price or maybe the dividend is only 4% or 3%. But if you look at the stock raising value over that same course of time, you're making a solid 10 to 12%. That's something to look into, especially if it's something that has been around for 50 years, 100 years. A good example is Coca-Cola. I have a lot of Coca-Cola stocks. I don't drink Coke at all, but boy, I got a lot of stocks. And I tell everybody I meet, drink Coke, baby, drink Coke. It helps me out. Okay, so the final thing though is, and before I give you the bonus here, have you subscribed yet? Come on now, you gotta subscribe because it really helps us out. My subscriber base is growing by a few people every day, and that's awesome. And I'd like to see you subscribe too, because what it does is it allows you to get a notification, if you click the notification bell too, that I've got a new video out. I try really hard to put a lot of videos all the time to help you out, help you grow a significant portfolio. So make sure you subscribe. Hey, let's get right into the bonus. So the bonus here is all about market diversification. I'm sure you've heard of it, and I'm sure some people are going to say diversification is for chumps, and the other people are going to say diversification is your saving grace. I believe it's your saving grace. I've even looked at people who say diversification is for chumps, and they're diversified. Let's say they've said, oh, I'm going to just I just got real estate and that's all I need is real estate. But what they're not telling you is they have real estate in this city here and this city over here and this city back there. That's their diversification. So instead of having real estate in one locale, they have real estate in multiple markets, in multiple locations, and that allows them to diversify once again. Diversification's king. You want to make sure that your investments are diversified, whether it's in stocks, whether it's in ETFs, whether it's in property, whether it's in businesses. And that's a great thing too. Even when you're looking at businesses, make sure you understand the businesses. Diversify, and if you're going to build a portfolio, diversify across multiple industries, multiple ideas. I have investments in property, I have investments in the stock market, but I also have investments in business. Sometimes some of them are losing it, but the other ones are gaining. That's the idea behind diversification. It helps you, again, balance everything out. Hey, I hope this helps you out. Hope this clears up the whole topic of risk and reward a little bit for you. Be sure to, like I said earlier, subscribe, absolutely, and be sure to check out this video that I got showing right here. It's a really great video that I want you to go check out because I'm not going to tell you. Talk to you then. Bye-bye.